All right, folks, buckle up. The Dow is wavering. Major indexes are on track for February losses, and the market is acting like it's allergic to good news. Benign inflation data? Nope, not enough. We're talking about serious headwinds, and your portfolio might be feeling the pressure. Is this the start of something big, or just a temporary dip? That's what we're going to unpack today. Get ready, because this is going to be intense. Let's kick things off with Dell. Shares took a nosedive after a soft sales outlook. I'm talking a 6% drop on Friday alone, and nearly 12% since the start of the year. Ouch. They projected fiscal 2026 revenue between $101 billion and $105 billion, falling short of analyst expectations. But hold on. Before you panic, there's a twist. Analysts at UBS are saying this could be a buying opportunity. They believe the soft revenue forecast was anticipated due to near-term market headwinds. Their price target? A whopping $150, almost a 50% gain from Friday's intraday price. It's a classic buy the dip scenario, or is it a trap? Let's dig deeper. This is a perfect example of the efficient market hypothesis in action. Price reflects all available information. But is it really efficient? Are analysts simply trying to soothe investors' nerves? The truth is often far more complex than it appears at first glance. Analysts use terms like unfavorable market conditions. We need to understand these conditions. High interest rates, decreased consumer spending, and increased competition can all play a role. This is where understanding macroeconomics is crucial. You can't just look at a single company. You need to understand the bigger picture. And remember, folks, analyst ratings are not gospel. Do your own research. Don't rely solely on what someone else tells you. This is your money. Treat it that way. JP Morgan analysts are echoing the bullish sentiment, reiterating their $150 price target. They believe server makers like Dell are poised to benefit from the booming demand for AI infrastructure. AI PCs and a rebound in PC sales could provide even further upside. Think about it. AI is the hottest sector right now. Everyone wants in. But is this hype justified? Are we in an AI bubble? These are the questions you need to be asking yourself. Dell's future is now tied to the success of AI. If AI continues to grow, Dell will likely benefit. But if the AI bubble bursts, Dell could be in serious trouble. The risk-reward ratio is crucial here. How much are you willing to risk for a potential reward? This is not just about Dell. It's about the entire tech sector. The rise of AI is reshaping the landscape, creating new opportunities and new risks. Stay informed, stay vigilant, and don't let the hype cloud your judgment. Now, let's talk about something really weird. Wall Street's Friday funk. The S&P 500's average return on Fridays this year has been negative. It's the worst day of the week for stocks. What's going on? Historically, Friday was a good day for stocks, but something has shifted. Deutsche Bank analyst Jim Reed suggests the weekends are becoming too risky for traders. There does seem to have been a trend of potentially negative news coming through late in the week, with the market wanting to reduce risk ahead of the weekend in case of escalation. Tariffs, geopolitical tensions, unexpected events, they all tend to drop on Friday afternoons, leaving traders scrambling. This phenomenon is a direct result of increased volatility and uncertainty in the market. Traders are becoming more risk-averse, especially heading into the weekend when they can't react to breaking news. This is where behavioral economics comes into play. Fear and greed drive market movements, and right now, fear seems to be winning on Fridays. But here's the kicker. Monday's performance is also negative. This suggests that the fear lingers into the start of the week. The market needs time to come to terms with the weekend's news, and that usually happens by Wednesday. So what's the solution? Should you sell your stocks on Thursday and buy them back on Monday? That's a risky strategy, and it's unlikely to be profitable in the long run. The key is to stay informed and be prepared for volatility. Don't panic sell based on short-term market fluctuations. Focus on your long-term investment goals, and don't let the weekend news cycle derail your strategy. It's a psychological game, folks, and you need to be mentally prepared to play it. Reed believes this pre- and post-weekend dip could continue until the news out of Washington stops putting markets on edge. In a world with lots of headline risk, it's possible traders will continue to want to be lighter heading into weekends than they would be if markets were calmer, he writes. Headline risk is a huge factor in today's market. Every tweet, every press conference, every political announcement can send shockwaves through the market. It's exhausting, I know, but you need to be aware of it. So what can you do? Diversify your portfolio. Don't put all your eggs in one basket. Consider investing in different sectors, different asset classes, and different geographical regions. This will help to mitigate your risk. Stay informed. Read the news, follow market analysts, and do your own research. The more you know, the better prepared you'll be to make informed investment decisions. And most importantly, don't panic. Market volatility is normal. There will be ups and downs. Don't let your emotions get the best of you. Stay calm, stay focused, and stick to your long-term investment strategy. Headline risk is something we have to live with. Learn to navigate it, and you'll be better positioned to succeed in the long run. Let's switch gears and talk about China. China-focused ETFs and stocks of Chinese companies listed on U.S. exchanges took a hit after Trump threatened to double existing tariffs on goods from China. The iShares MSCI China ETF, MCHI, and the iShares China Large Cap ETF, FXI, both fell more than 2%. Alibaba, JD.com, NIO, Li Auto, they were all down. Trump's tariff threats are sending a clear message. The trade war is not over. This is not just about economics. It's about geopolitics. The U.S. and China are locked in a power struggle, and tariffs are a key weapon in that struggle. The impact on your portfolio depends on your exposure to Chinese markets. If you have significant investments in China, you're likely feeling the pain. But even if you don't, the trade war can have ripple effects on the global economy. Higher tariffs can lead to higher prices for consumers, lower profits for businesses, and slower economic growth. But here's the thing. Chinese shares have outperformed the S&P 500 this year. The MSCI China ETF is up 14%, while the S&P 500 is roughly flat. So, is this a buying opportunity? Or is it a sign of more trouble to come? This is a tricky situation. China's economy is growing rapidly, but it's also facing challenges, including high debt levels and regulatory uncertainty. Investing in China is a high-risk, high-reward proposition. You need to be prepared for volatility and be willing to take a long-term view. The risk is real. The potential reward is significant. The choice is yours. Now for some good news. Elastic shares jumped after reporting better-than-expected earnings, thanks to strong demand for AI-related products. Their adjusted earnings per share were 63 cents, well above analyst estimates. Revenue was up about 17% year-over-year. Customers with an annual contract value greater than $100,000 rose 15%. Continued interest from customers building generative AI applications and consolidating onto a single platform helped drive our outperformance during the quarter, said CEO Ash Kulkarni. Elastic is riding the AI wave, and their success is a testament to the power of innovation. They're providing the tools that companies need to build and deploy AI applications, and that's a very valuable position to be in right now. Their full-year outlook also exceeded expectations. This is a company that's firing on all cylinders. But is this growth sustainable? Can Elastic continue to outperform in the long run? The AI market is highly competitive, and there are many other companies vying for market share. Elastic needs to continue to innovate and stay ahead of the curve. This is a company to watch. They're in a hot sector, they have a strong track record, and they have a clear vision for the future. But remember, no company is immune to risk. Do your research and make sure you understand the potential downsides before investing. Let's zoom out and look at the bigger picture. Earnings season. As of Thursday, the S&P 500 reported growth in earnings of almost 18%, the highest since the fourth quarter of 2021. That's fantastic news. 77% of the companies had beaten Wall Street's earnings per share, EPS, estimates. Financial institutions were the best performing sector, chalking up 55% growth in earnings. This is a sign that the economy is stronger than many people think. But there's a catch. Tariffs are weighing on corporate minds. The term tariffs was mentioned in earnings calls at least once by the 221 companies that reported between December 15th through February 21st. Companies are worried about the impact of tariffs on their bottom lines. Economists are concerned that steep new tariffs could push up prices on consumer products, reigniting inflation while weighing on economic growth. And here's another downbeat conclusion. 72 companies issued negative EPS guidance, exceeding the 5-year average. This suggests that companies are becoming more cautious about the future. Several consumer-focused companies' reports are due next week, including Costco, Best Buy, and Target. These reports will give us a better sense of the health of the consumer. Are people still spending money, or are they starting to tighten their belts? Earnings season is a crucial time for investors. It gives us valuable insights into the performance of companies and the overall health of the economy. Pay attention to the details, and don't be afraid to ask questions. This is your chance to learn and grow as an investor. Finally, let's talk about the overall market performance. The Dow, S&P 500, and Nasdaq Composite are on track to post big losses for the month. The Nasdaq Composite is down 5.5% this month, its worst month since September 2023. The S&P 500 is down 3% in February, its worst performance since last April. The Dow's 2.9% decline is noteworthy, but it's not as bad as its 5.3% decline in December. Just over a week ago, the S&P 500 was hitting all-time highs. What happened? A combination of factors: tariff threats, inflation concerns, sector-specific woes, and overall market volatility. The market is a complex beast, and it can turn on a dime. It's important to remember that market corrections are normal. They're a healthy part of the economic cycle. Don't panic sell. Stay calm, stay focused, and stick to your long-term investment strategy. This is a time to be cautious, but it's also a time to be opportunistic. Look for undervalued companies that have strong fundamentals. This could be a chance to buy low and profit when the market rebounds. The key is to be patient and disciplined. Don't let your emotions get the best of you. Invest wisely, and you'll be well-positioned to succeed in the long run. Hold on, there's another story brewing. Gold price surged to a fresh record past $2,900 Monday as President Trump announced 25% tariffs on steel and aluminum imports, and investors brace for inflation data later this week. Gold, the classic safe haven asset, is shining bright amidst the market turmoil. The prospect of looming trade wars continues to cloud the global growth outlook, prompting investors to flock to gold as a way to hedge against increasing economic uncertainty. Gold's price has continued to move sharply higher, indicating a continuation of the commodity's strong uptrend. Gold's next cue will likely come from this week's inflation data. A weaker-than-expected reading would underpin the commodity's rally by boosting rate cut expectations, making non-yielding gold more attractive than its interest-bearing alternatives. Since breaking out above a symmetrical triangle last month, gold's price has continued to move sharply higher, indicating a continuation of the commodity's strong uptrend. Moreover, the Relative Strength Index, RSI, confirms bullish price momentum with a reading above the 70 threshold, though the indicator also points to overbought conditions, which could lead to near-term profit-taking. Using technical analysis, investors can project an upside target by using the measured move technique. When applying the analysis to gold's chart, we calculate the distance of the trend that preceded the symmetrical triangle and add that amount from the start of the commodity's current move higher. For example, we add $502 to $2,596, which forecasts a target of $3,098, an area about 6% above current trading levels where the price may undergo a consolidation phase. During retracements, investors should initially eye the $2,790 level, a location on the chart that may provide support near the October peak, which also marks the top of the symmetrical triangle. The bull's inability to defend this level could see the price decline to around $2,530. The commodity finds a confluence of support in this area from a brief consolidation period in August last year, the low of the symmetrical triangle, and the nearby 50-period moving average. Finally, a more significant drop opens the door to the gold price revisiting lower support at the $2,430 level. Investors could look for buy-and-hold opportunities in this region near the top trend line of a rectangle that formed on the chart between April and July last year. Is gold a safe haven? Absolutely. But it's not a guaranteed win. Gold prices can be volatile, and they can be affected by a variety of factors, including interest rates, inflation, and geopolitical events. Don't put all your eggs in the gold basket. Diversify your portfolio and be prepared for volatility. Gold is a valuable tool, but it's not a magic bullet. Use it wisely, and you'll be better positioned to protect your wealth in uncertain times. Adding fuel to the fire, the Dow closed 300 points lower Friday, as the White House announced tariffs would start Saturday. The S&P 500 slid following news that President Donald Trump's aggressive tariffs against major U.S. trading partners would begin on Saturday. The broad market index shed 0.5% to close at 6,040.53, while the Dow Jones Industrial Average tumbled 337.47 points, or 0.75%, weighed down by a decline in Chevron. Stocks gave up their earlier gains after White House Press Secretary Caroline Leavitt announced on Friday afternoon that the president's tariffs will be available for public inspection at some point Saturday. Trump will be leveling 25% tariffs on Canada and Mexico, alongside a 10% duty on China. At its session highs, the blue-chip Dow had risen more than 170 points. Stocks with exposure to these markets reacted, such as Corona Brewer Constellation Brands and Mexican food chain Chipotle, which respectively shed nearly 2% and 1% upon the news. Apple exceeded fiscal first-quarter expectations, but the stock ended the session 0.7% lower. Shares of Chevron and ExxonMobil dipped 4.6% and 2.5%, respectively, on the back of disappointing fourth-quarter results. Friday's release of the December data for the Personal Consumption Expenditures Price Index, the Federal Reserve's preferred inflation gauge, showed an increase of 0.3% from November and a 2.6% annual rate. While this yearly advance was in line with economists' expectations, it marked an acceleration from the prior month's rate of 2.4%, raising some concerns that inflation remains sticky. Excluding food and energy, core PCE also increased 0.2% monthly and 2.8% on an annual basis. What does this all mean? The market is reacting negatively to the uncertainty surrounding tariffs and inflation. Investors are worried about the potential impact on economic growth and corporate earnings. The Fed is in a tough spot. They need to keep inflation under control, but they don't want to derail the economy. The market is walking a tightrope, and any misstep could send it tumbling. Be prepared for volatility, and don't make any rash decisions. This is a time to be cautious, but it's also a time to be strategic. Stay informed, stay disciplined, and you'll weather the storm. Now, for something completely different, Tulsi Gabbard's net worth. President Donald Trump's nominee for Director of National Intelligence, ex-U.S. Congresswoman Tulsi Gabbard, has an estimated net worth of $1 million, according to Celebrity Net Worth. Gabbard, who represented Hawaii in Congress, has built her wealth through her media company, speaking engagements, a book, and lucrative investments. Gabbard's investments include Rumble, Tesla, and Bitcoin. Gabbard's Tulsi Media LLC, which encompasses her media, digital media, public speaking, and book royalties, and TOA Studios LLC brought in about $411,000 in 2024, according to Gabbard's most recent federal executive branch financial disclosure filed in January 2025. That amount also includes about $3,500 in ad revenue from her podcast, The Tulsi Gabbard Show. Gabbard earned a little under $300,000 in an advance for her book, For Love of Country, Leave the Democrat Party Behind. Gabbard also earned almost $200,000 as a contributor on Fox News and about $120,000 as a media contributor for the American Center for Law and Justice. The former Congresswoman brought in about $170,000 from speaking engagements in 2024, including Republican Party events in different cities and at the conservative think tank Heritage Foundation. Gabbard is invested in conservative-leaning streaming platform Rumble, RUM, and electric vehicle maker Tesla, TSLA, with her stock in both companies valued between $100,001 and $250,000 at the time of the early January filing. The disclosure report also showed smaller investments in technology companies NVIDIA, NVDA, and Apple, APL. The disclosure also reveals a Crypto.com wallet containing holdings of Bitcoin, Kronos, Solana, and Ethereum. Gabbard's Bitcoin holdings are valued between $15,001 and $50,000, while those of the other three cryptocurrencies are valued between $1,001 to $15,000. Gabbard filed a separate form claiming that she would divest from NVIDIA, Rumble, Tesla, Apple, and her crypto holdings within 90 days should she be confirmed, to avoid any actual or apparent conflict of interest. Why are we talking about this? Because it's important to understand the financial interests of our leaders. Do her investments influence her decisions? That's a question you need to ask yourself. It's all part of the bigger picture, understanding the forces that shape our world. It's about power, influence, and money, and it's something you need to be aware of. So, what's the takeaway from all of this? The market is facing significant challenges. Tariffs, inflation, and geopolitical uncertainty are all weighing on investor sentiment. Volatility is likely to continue in the near term, but there are also opportunities. Companies like Elastic are thriving in the AI sector. Earnings season has been surprisingly strong, and gold is shining bright as a safe haven asset. The key is to stay informed, stay disciplined, and stay diversified. Don't let your emotions get the best of you. Invest wisely, and you'll be well positioned to succeed in the long run. Remember, the market is a marathon, not a sprint. Don't try to time the market. Focus on your long-term goals and let compound interest work its magic. And most importantly, don't be afraid to ask for help. Consult with a financial advisor and get a second opinion. This is your money. Treat it with respect. The market is a wild ride, but it's also a rewarding one. Stay informed, stay focused, and you'll be well positioned to achieve your financial goals. Thanks for watching, and I'll see you next time.